Picture this. While everyone's chasing after expensive blue chip stocks, some of the most explosive opportunities in the market are trading for less than the price of your morning coffee. I'm talking about stocks under $5 that have the potential to deliver returns that could transform a modest investment into something truly substantial. Today, we're diving deep into three companies that aren't just cheap. They're positioned at the intersection of technology, innovation, and massive market trends that could define the next decade. These aren't your typical penny stocks destined for obscurity. These are real companies with actual revenue, cutting edge technology, and partnerships with some of the biggest names in their industries. So, if you're ready to discover opportunities that Wall Street might be overlooking, stick around because what I'm about to share could be the edge you've been looking for in your portfolio. Before we jump into these specific opportunities, let's talk about why stocks under $5 deserve your attention right now. The market has been brutal to growth stocks, especially in the tech sector, and many fundamentally strong companies have seen their share prices crushed not because their business models failed, but because of broader market sentiment and rising interest rates. This has created a unique window where sophisticated investors can accumulate positions in companies with genuine growth prospects at prices that seemed impossible just a couple of years ago. But here's the critical distinction. We're not talking about pump and dump schemes or companies with nothing but promises. The three stocks we're examining today have established operations, significant partnerships, and are positioned in industries experiencing genuine, measurable growth. The key is knowing which ones have the fundamentals to eventually reward patient investors. Let's start with Grab Holdings, a company that's revolutionizing transportation and delivery services across Southeast Asia. This isn't just a ride hailing service, they've evolved into a super app offering food delivery, package delivery, and digital financial services to hundreds of millions of users across multiple countries. The size of their addressable market is staggering. We're talking about a region with over 600 million people, many of whom are just beginning to adopt digital services. Their latest quarterly results showed some truly impressive metrics. Gross merchandise value, which measures the total value of transactions on their platform, increased by approximately 24% year over year. What's even more encouraging is that they're demonstrating improving unit economics, meaning they're making more money per transaction while spending less to acquire and retain customers. The company recently achieved profitability on an adjusted EBITDA basis for the first time, which is a major milestone that shows their business model is maturing. They've also been expanding their financial services division, which includes digital payments, lending, and insurance products, services that carry much higher margins than their core mobility business. In terms of partnerships, they've secured strategic investments from major Asian conglomerates and have formed alliances with local banks to expand their fintech offerings. The regulatory environment in their operating regions has been challenging, but they've successfully navigated these hurdles and have actually benefited from some competitors exiting the market. The stock trades at a fraction of the valuations assigned to comparable Western companies, largely because of geographic bias and concerns about emerging market exposure. But for investors willing to look beyond these surface level concerns, the growth trajectory here is compelling. Grab's ecosystem approach creates powerful network effects. The more drivers they have, the better the service for riders, which attracts more drivers. This same dynamic applies across their delivery and financial services segments. Their super app strategy means they can cross sell services to their existing user base at minimal acquisition costs, which is a significant advantage in markets where customer acquisition can be expensive. The company's focus on financial inclusion in Southeast Asia positions them to capture a massive opportunity, as millions of unbanked and underbanked consumers gain access to digital financial services for the first time. Moving to our second opportunity, we're looking at Big Bear, AI Holdings, a leader in artificial intelligence and machine learning solutions that is working directly with government agencies and commercial enterprises. This company specializes in decision intelligence, which essentially means they help organizations make better decisions by analyzing massive amounts of data in real time. Their technology is being used in national security applications, supply chain optimization, and predictive maintenance, sectors that aren't going away regardless of economic conditions. In their most recent quarterly report, they showed revenue growth of approximately 32% year over year, which is remarkable given the challenging environment many tech companies are facing. What's particularly interesting is their expanding customer base within the defense sector, where they've secured multiple contracts that provide recurring revenue streams. The company recently announced a significant partnership with a major cloud provider to integrate their AI solutions into enterprise platforms, potentially opening up access to thousands of new commercial customers. Their backlog of contracted work has been growing consistently, which provides visibility into future revenue that many penny stocks simply don't have. Now, they're not yet profitable, which is important to acknowledge, but their path to profitability is becoming clearer as they scale their operations and their gross margins continue to improve. The stock has been beaten down primarily due to broader market concerns about unprofitable tech companies, but for investors with a 2 to 3 year horizon, the current valuation could represent a compelling entry point. Big Bear. AI's competitive advantage lies in their proprietary algorithms and their deep relationships with government agencies, which creates high barriers to entry for competitors. Their technology platform is designed to be scalable and adaptable across multiple industries, which means as they prove their value in one sector, they can relatively easily expand into adjacent markets. The defense and intelligence community represents a massive addressable market with long term contract cycles and stable funding, providing a solid foundation for their growth trajectory. Our third company is Plug Power, operating in the hydrogen fuel cell space, an industry that's positioned at the forefront of the global transition to clean energy. This company designs and manufactures hydrogen fuel cell systems for applications ranging from forklifts and delivery vehicles to backup power systems and large-scale transportation. The hydrogen economy is moving from theory to reality, with governments worldwide committing billions of dollars to infrastructure development and companies scrambling to decarbonize their operations. Plug Power has partnerships with some of the largest logistics companies in the world, and they've installed thousands of fuel cell units in warehouses and distribution centers. In their recent quarterly report, they disclosed year-over-year revenue growth of over 40% in certain segments, driven by increasing demand for their material handling products. They've also been expanding internationally, with significant deployments in Europe, where environmental regulations are accelerating the adoption of zero-emission technologies. One of the most exciting recent developments has been their strategic collaboration with several automotive manufacturers to develop fuel cell systems for commercial trucks and buses. The heavy-duty transportation sector is particularly well-suited for hydrogen because batteries become impractically large and heavy for long-haul applications. The company has also secured substantial government grants and tax incentives as part of broader clean energy initiatives, which helps offset some of their development costs. Now, let's address the elephant in the room. They're burning through cash as they scale production and invest in next-generation technology. Their liquidity position has been a concern, and they've had to raise capital through stock offerings, which has diluted existing shareholders. However, they recently announced plans to improve their cash flow position through operational efficiencies and have guided toward reduced losses in upcoming quarters. The hydrogen infrastructure is still in its early stages, which means this is definitely a higher risk investment. But if the industry develops as many experts predict, Plug Power is positioned as one of the primary beneficiaries. The company is also vertically integrating by building their own hydrogen production facilities, which could significantly reduce their costs and improve margins over time. Their established customer relationships and extensive installed base give them valuable data and feedback that helps them continuously improve their technology, creating a competitive moat that will be difficult for new entrants to overcome. Now let's talk about risk management, because that's absolutely critical when you're investing in stocks at these price levels. First and foremost, these should represent only a small portion of your overall portfolio. Typically, no more than 5 to 10% of your total investment capital should be in speculative positions like these. The volatility in stocks under $5 can be extreme, with 20 or 30% moves in either direction happening in a matter of weeks or even days. You need to be comfortable with that level of fluctuation and have the emotional discipline not to panic sell during inevitable drawdowns. Diversification within this category is also important. Rather than putting all your capital into one of these stocks, consider splitting your allocation across all three to reduce company-specific risk. It's also worth setting clear exit criteria before you invest, both for taking profits if things go well and for cutting losses if the thesis breaks down. Stop-loss orders can be useful, but be careful with them in volatile stocks, because you might get shaken out during normal price fluctuations. The other critical factor is staying informed. These companies are still growing and evolving, so you need to monitor their quarterly reports, watch for significant partnership announcements, and pay attention to insider trading activity, which can sometimes provide early signals about company trajectory. The bottom line is this: all three of these companies are operating in industries with substantial long-term growth potential. They have real products and services generating actual revenue, and they're trading at valuations that reflect considerable pessimism. That pessimism might be warranted in the short term. Macro conditions remain challenging, and any of these companies could face operational setbacks. But for investors with patience and the ability to think beyond the next quarter, the current prices could represent asymmetric opportunity where your potential upside significantly outweighs your downside risk. Big Bear gives you exposure to artificial intelligence and defense technology. Grab provides access to the massive Southeast Asian digital economy, and Plug Power positions you in the emerging hydrogen economy. Together, they represent a diversified bet on some of the most significant technological and economic transitions of our time. As always, do your own additional research, consider your personal risk tolerance, and never invest money you can't afford to lose. If you found this analysis valuable, make sure to subscribe for more deep dives into undervalued opportunities in the market. Here's to finding those hidden gems before everyone else does.